Distinguished colleagues and fellow committee members, we are gathered today to discuss the current outlook for the United States economy and what potential changes need to be made in order to stabilize it moving forward. Throughout this meeting, we will discuss the current state of the economy, short and long-term forecasts, and potential risks, concluding with decisions around monetary and fiscal policy. The Federal Reserve operates under a dual mandate of price stability and maximum sustainable employment. Throughout this meeting, we will attempt to show why an increased focus on this mandate, and specifically on unemployment, will be paramount in recovering our economy. Our discussion will begin with a talk about the current state of the economy, beginning with Mr. James.
Mr. Ward, thank you. Gross domestic product contracted at the fastest pace on record in Q2. With continuing stay-at-home orders, mass unemployment has caused a sharp decline in consumer spending, resulting in less funding for private investment. These decreases are the primary reason for the sharp decline in GDP shown on the graph. Let's get a closer look at consumption. Let's go to Ms. Ibnov.
Thank you, Mr. James. To properly gauge inflation, we look at the annual percent change in core PCE, which shows consumer spending without the volatility brought by food and energy prices. Core PCE fell 0.73% from March to April, causing inflation to drop well below the Federal Reserve's 2% benchmark. To combat this, the federal funds rate was set to a lower limit of 0 and an upper limit of 0.25% this past August, a change which the Fed has implied will continue into 2023, which is the expected amount of time for inflation to moderately exceed 2%, setting us back on track for further inflation. The rebound in core PCE seen in May is a result of pent-up demand, with consumers returning to buying due to income given through the first fiscal package and a partial return of employment. However, I fear that if there were to be another COVID-induced unemployment spike, it could drive consumer spending even lower, pulling money out of the economy and resulting in deflation. Therefore, I suggest this committee continue to focus our efforts on boosting employment. Now I'll pass it back to Mr. James for a discussion on unemployment.
She's right. We are currently exiting the worst employment period since the Great Depression. April 2020 showed the worst month for employment in American history, with 20 million jobs lost. This caused the U3, our most common measure of unemployment, to skyrocket to almost 15%. Recently, though, unemployment has improved to just under 8%. With the complex labor market picture, it's important to consider the U6, which includes discouraged workers, marginally attached individuals, and part-time workers. At the height of the unemployment spike, nearly 1 in 4 of those that fit into the U6 parameters were underemployed. The U6 currently sits at 12.8%, suggesting there's a lot of room left to grow. Certain economic sectors have seen unemployment numbers remain fairly steady, others not so much. Ms. Ibnov?
Exactly. These economic conditions that have been introduced since the start of COVID-19 are magnified when examining unemployment by sector. The loss of revenue coupled with stay-at-home orders leaves individuals in the service sector unable to return to work, which is where the large spike in unemployment seen in Q1 comes in. Differences in unemployment rates are evident by industry, with the service sector's unemployment rate having peaked at 27.2% and manufacturing at 13.2%. The financial sector, however, is a much smaller rate at only 5.7%. Industries seeing the most layoffs and lowest prospects for a return to work are primarily made up of low-income workers, which face a much higher risk of a sudden loss of income than white-collar ones. Without a vaccine, the health to economic trade-offs will be far too risky for the service sector to return to work in full, potentially resulting in permanent job loss for those in the service sector and other at-risk sectors. Now we'll move into an analysis of financial markets, beginning with Mr. Lee.
Thank you, Ms. Ibnov. The VIX measures the volatility of financial markets within the United States and is being compared against the 10-year Treasury constant maturity rate. Typically, the VIX and the 10-year have an inverse relationship due to exogenous shocks to the financial markets as shown in the past. As indicated on the graph, the two crossed at the start of the pandemic, as we would expect them to. However, the VIX has started to return to more stable levels while the 10-year has remained steady. The reason for the yield remaining low has to do with massive government spending. The biggest buyer during the pandemic has been the federal government, as seen on this graph of asset holdings by the government compared against the 10-year yield. This graph indicates that the government's massive purchasing of assets has held down the yield. The fact that they have yet to move out of the safest asset indicates that the federal government's lack of confidence in quick recovery that some predicted. Given this information, I believe that the near-term outlook is still uncertain and that continued holding of treasuries may be necessary to maintain stability. The massive purchasing since March has translated onto the Fed's current account balance. During the last recession, the deficit decreased, but at the beginning of this recession, we are beginning to see an increase in our national deficit. The decline in the current account is a result of foreign investors moving their assets into one of the safest assets, treasuries. Along with foreign investment, the massive amount of government spending has led to a massive increase in our national deficit. Now, Mr. Ward will discuss the issues with public debt.
Thank you, Mr. Lee. Now, this graph displays the collective debt of households, nonprofits, businesses, and the federal government together as a percentage of GDP. Now, this graph is useful because it shows the collective credit position of all different levels of the economic structure of the country, from student loans and mortgages all the way up to government debt, and compares it to how well the economy is performing. The debt of the country was increasing during the expansion and has increased even further since the pandemic began. When debt is high during a recession, corporations are forced to use what little discretionary income that they're receiving on debt service payments, slowing their ability to hire and rehire. If corporations are not able to hire as quickly, this means that individuals will be using their limited amounts of disposable income on debt payments as well. The hit from these issues could potentially be buffered with a congressional stimulus bill, but with talks recently stalling, coupled with the potential for another outbreak this winter of the virus, the short-term performance of the economy is still in question. Now, moving on to the long-term outlook. Federal debt by itself also increased substantially during this time, with the Fed doing a lot of buying in financial markets, as Mr. Lee mentioned. Now, this level of debt is sustainable during an expansion with consistent GDP growth, as seen during the last expansion, with GDP and debt increasing at the same rate. However, increased federal debt soaks up savings and crowds out foreign investment. Now, this can lead to growth being slowed, which is dangerous for the economy during a time in which GDP is already trending downward. A year ago, federal debt made up just 79% of GDP, but the Congressional Budget Committee believes this number will rise to 189% by 2049. Given all of this, I believe the long-term outlook will remain fairly negative if this level of debt is not resolved. Therefore, this debt should be considered a risk and monitored very carefully by this committee and others. I will now pass to Mr. Stempel to discuss reserves.
Thank you, Mr. Chairman. Reserves held at the Fed gives us insights into the depository institution's lending amounts and shows what kind of asset safety net that they are currently operating with. Before the pandemic began, reserves held at the Fed were low, most likely stemming from high lending levels and a low amount of asset purchases. Once the pandemic began, reserves began to climb rapidly as the government purchased massive amounts of assets in order to keep liquidity high. This occurred throughout March before the presence of a stimulus package and the Treasury's new lending facilities. This quick action helped buffer what could have been catastrophic economic losses while Congress worked to sign the CARES Act into law. There are things that are concerning the reserve position of banks. In May, the amount of reserves began to go back down, indicating some recovery of confidence. This could also be a result of this committee's decision to lower reserve requirements to zero. This allowed depository institutions to reduce their reserves when they saw fit. I see this as a risk, as in the middle of the recession, depository institutions need to be able to meet cash needs, which requires higher reserve amounts. While liquidity is paramount currently, we need to consider our economy's short and long-term exposure in our policymaking.
Thank you, Mr. Stempel, for that insight. Finally, we will all move into a discussion of policy decisions and eventually voting on those policies. Now, in order for the short-term performance of the economy to avoid any further decline, we strongly recommend that Congress pass a stimulus package in the very near future. While this committee and the Federal Reserve can inject liquidity into financial markets in our own way, a more direct injection into the real economy will help to keep the country afloat financially in the short term. However, if legislators are unable to come to an agreement, I vote that this committee authorize a further increase in asset purchases, specifically increasing our Treasury securities holdings even further. This will ensure that financial liquidity will be at least stable for the short term as it has so far, and it will keep the financial position of the government in the safest asset. Now, all in favor of a further increase in asset purchasing? The motion will pass. Now, are there any other policy recommendations that a committee member would like to suggest?
Yes, Mr. Chairman. I would like to suggest that the committee consider raising the reserve requirement. I understand the board's opinion to prioritize liquidity in financial markets, However, given the debt levels shown in the presentation, it is imperative to keep the long-term effects of our actions in mind. I recommend increasing the reserve ratio to 3% in order for depository institutions to have the necessary capital when entering a period of great economic uncertainty.
I would like to disagree with Mr. Stemple. If we were to raise the reserve requirement, this could dry up liquidity in the short term, which would amplify any economic downturns we could see due to the uncertainty of the markets right now.
We must consider that without fiscal stimulus from Washington and no secure vaccine allowing for a full return to work, housing insolvencies and bankruptcies are sure to be on the rise. In order to mitigate risk of this turning into a financial crisis, we have to have at least a 3% reserve requirement moving forward.
While I acknowledge Mr. Stemple and Mr. James's want to consider long-term risks in our decision-making, and we always have and we will in the future, I feel that the focus needs to be on getting out of this current recession we're in right now in whatever way we can. And then once we start to see some more positive GDP growth and we start to firmly come out of the recession, then we can start talking about preparing for another potential downturn. But I believe the focus should remain right now, and we should keep the reserve requirement at 0 for the short term. But thank you all for your insight. All in favor of raising the reserve requirement? All opposed? The motion will be denied, but we thank Mr. Stemple and Mr. James for their insights, and they will be considered moving forward. Lastly, we must vote on the federal funds target range. I anticipate that this committee will agree that we need to keep the range from 0 to 0.25% in order to keep lending rates low and avoid less liquidity in the market. All in favor of holding the rates where they currently are? The motion will pass. This concludes the Federal Open Market Committee meeting. Thank you all for your time.